Just a quick Q1 recap. Tesla's Model I became the best-selling vehicle of any kind in Europe and the best-selling non-pickup vehicle in the United States. And this achievement came despite a lot of challenges in production and delivery. So huge credit to the Tesla team for achieving these remarkable results. Hey guys, welcome back. Today we're diving into one of the hottest topics in the stock market right now. Tesla's record-breaking first quarter earnings. Yes, you heard it right. Tesla is on fire. I'm not just talking about their electric vehicles. With the release of Tesla's earnings report for Q1 2023, the results are quite interesting, and they really show the direction we might want to take for our portfolios. So let's jump right in. We all know that the after-effects of the pandemic still linger in the economy, and Tesla isn't immune to these challenges. But what's really interesting is how the company is adapting to the situation. They've been lowering the prices of their vehicles. It's finally starting to show up in their financial statements. So let's take a closer look at the numbers. Tesla's operating income is the most important thing to note this quarter. But here's the kicker. Not all the numbers are as rosy as we'd like. Tesla's gross profit has taken a hit, dropping from $5.5 billion in Q1 last year to $4.5 billion this year. This marks a year-over-year decline in gross profit that we haven't seen in quite some time. And that's not all. Last year, during China's lockdown, Tesla actually had growth, but this year the price cuts are having a very real impact on their profitability. Looking at the earnings report, Tesla made $2.7 billion in operating income, which is a bit lower than Q1 2022 and the lowest in a while. Now, you might be thinking, why are we excited if operating income is lower than before? Well, let me explain. The thing is, all of Tesla's current valuation is based on the fact that they are a massive growth company. If they can consistently bring in $5 billion in earnings per quarter, that means $20 billion in earnings for the year. At a 25 times price-to-EBIT ratio. This justifies a $500 billion valuation. But here's the catch. Hitting that $20 billion earnings mark might be a bit more difficult this year. That's where Tesla's Q1 earnings report comes in. While operating income might be lower, their gross profit and profitability are still holding up pretty well, which means Tesla is still growing and expanding. Even if they may not hit that $20 billion mark, they are still on track to do well in the long run. Let's talk about revenue. Tesla's revenue for Q1 was $23.3 billion. Yes, you read that right. That's insane. But what's even more impressive is that their operating income was 19.3%, the lowest it's been in 4 quarters. Now, keep in mind that this doesn't even factor in all the price declines that happened in Q2, so we might see these numbers drop even further. Here's where it gets interesting. Tesla's model allows them to profit from every incremental $1,000 they make from full self-driving, FSD, but they only make around $5,000 to $15,000 on a car. So even a decrease of $1,000 to $3,000 can have a significant impact on their margins, which in turn affects their income statement. It's like a never-ending cycle of financial jargon. But here's what I find fascinating. We're watching a real-time economic case study unfold right in front of us. Initially, I thought Tesla would easily shrug off these price cuts and earnings would remain flat for a bit. But now, I'm starting to think earnings might actually start to decline. Looking at Tesla's operating income on an annual basis, last year they made $12.6 billion, which was impressive. But with Q1's numbers putting them at a lower run rate, it's unclear whether they'll be able to reach that $20 billion mark, and that's where it really hits home for us stockholders. With earnings growth uncertain, it becomes trickier to justify Tesla's $1 trillion or even $500 billion market cap. Of course, we all have faith in the company and its ability to innovate, but at the end of the day, the numbers don't lie. But let's take a step back for a second and look at last year's numbers. Tesla's energy business hit a record-breaking $1.3 billion in revenue. This year, they outdid themselves and soared to $1.5 billion in revenue. How did they do this? With incredible growth in their Megapack business. They've been deploying batteries like crazy, hitting 3.9 gigawatt hours, and they recently opened a new mega factory in Shanghai, which will only accelerate that growth. Now, I know some of you might be concerned about the recent price cuts and their impact on earnings, but hey, we're all in this for the long haul, right? As shareholders, it's definitely something to keep an eye on. While deliveries are growing by 30% and revenue is up by 20%, we are seeing EBITDA and gross profit shrink. If these price cuts continue, earnings growth might not materialize, which could be a concern for a growth stock like Tesla. But don't worry, I still believe in Tesla's long-term vision. Okay, let's get real for a second. Yes, Tesla's Q1 earnings might be looking a little soft, but let's not forget that they are still the most profitable and strongest company in the EV space. That spells bad news for competitors like Rivian and Lucid. Sorry, but not really sorry, right? Tesla has plenty of cash to get through this and is going to be fine in the long run. However, it's interesting to note that during this recession, earnings could go down or flatline for a bit, impacting what's been a strong growth story. But let's not focus on the negative because there are so many positives to talk about. Tesla's energy business is booming and the Megapack business is leading the way. And let's not forget about their incredible electric cars, which are changing the game in the auto industry. Every day, more and more people are switching to electric cars, and Tesla is at the forefront of that revolution. Now, if all of that doesn't satisfy you, then take a look at what Musk is planning to bring out in the next few months. Yes, Tesla is planning to launch a more affordable platform, and I think the charts could go absolutely wild. This new platform will be used to create the much-awaited $25,000 Tesla. Yes, you've heard that right. According to Musk's comments during the Q3 earnings call in October 2022, this next-generation platform will cost half as much to produce as the current Model 3 and Y platform. And we all know how successful those models have been. So just imagine what Tesla could do with a platform that costs even less to produce. Let me clarify. The new platform won't mean the new Tesla will be exactly half the price of the Model 3 or Y. What it does mean is that the price will be significantly lower, making it accessible to a wider audience. And let's be real, who wouldn't want a Tesla at a lower price point? But it's not just about the price. The next generation platform will also be a huge leap forward for Tesla in terms of production volume. Musk has claimed that production volumes for this platform will surpass even the Model 3 and Y, which is a massive achievement in itself. This means we can expect to see more Tesla vehicles on the roads, and hopefully a decrease in wait times. And we all know that's great news for shareholders. Now, coming back to where we are right now, I know some of you might be worried about Tesla's valuation coming down to more reasonable levels, but let's not forget that it's still a massive earnings machine. With such strong sales, there's still plenty of room for growth. But as we said before, we can't give Tesla a 10 out of 10. The company is starting to see a slowdown in growth. That's part of the maturity process. And with maturity comes a more reasonable valuation. There's no denying that there's some economic uncertainty out there, and that can have an impact on the stock market. But don't worry, even with the bearish technical patterns, Tesla is still a stock that investors should keep an eye on. We just have to take a wait-and-see approach. Here's the kicker. At lower levels, Tesla could actually be a much better investment. So if you're thinking about investing in Tesla, now might be the perfect time to do so. So guys, drop your thoughts on the latest earnings call in the comments below. Let's keep the discussion going, and we'll meet again soon with another episode.